You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, the Life Insurance Income Series 3, the tax items. And on today's show, the tax advantage menu of life insurance with national financial columnist and CPA Ken
When
Davis.
it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant. We're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain, and day 3 and all this week with me, Mr. CLU, CHFC, CFP, and CPA Ken Davis.
Hey, Stephen.
Hey, Ken, we're talking about, we have to go into kind of Ken's land to define everything we're talking about this week, especially if you're using arbitrage loans and my new twist on it. Hey, I can't get a deduction for this, but can I reimburse myself every year using arbitrage loans? And a couple of carriers, not everybody, only a very few carriers, are actually allowing access to policy loans in the first year. And if you wanted to say, well, I didn't get the deduction, we talked about this Monday show, Tuesday, who are the people that we should qualify for? Because this is a leveraged idea. You need to think about this. Now, today we're talking about all the issues that are around life insurance, arbitrage loans, not so much the things that could or could not happen. We've already addressed that a couple weeks back, but we're really talking about taxes and how it hits. Now, the reason I bring this up is because I may want to trade. I might want to trade my tax deduction on ERISA because my tax bracket's low, because why should I take the deduction when it may impact my Social Security benefits from being taxed? You have to measure this now and what it could be. And right now, I don't know if brackets are going to be higher or not. Ken, I don't have a crystal ball.
No,
okay?
nor do I.
I don't know if it's going to be even, but when you're playing defense for your client, I think you got to take the worst scenario. And right now, the exposure on Social Security, I mean, from an ERISA product, it's there now. I don't know, it could get bigger. They told us back in the day that they were never going to tax Social Security. Well, that's all over, right? And if they need more money, and especially for people who are affluent, we may have to pay even more. But what I'm talking about today is I want to talk about some of our other tax issues and items just to clarify how this, if it's done right, it can be powerful for the client. And let's just go through the first thing. We talked about this Monday, you just touched on it, but it bothers me deeply, Ken, the alternative minimum tax. It was targeted for rich people who knew how to use, and I have to say, maybe the CPA Society was complicit in this,
No.
How the CPA, the law is the law. They know how to work the contracts. They know how to game the system, and they did such a great job that they had to create alternative minimum tax because rich people, even at 70% tax brackets back in the day, right, were avoiding taxes, period. So they introduced alternative minimum tax, and it was targeted for who?
The rich.
The rich. But now, since there's been no inflation, no regulatory changes, the AMT is now touching normal middle-class Americans. So let's talk about the AMT, because in our retirement issue, the AMT will never be an issue.
Well, yeah, that's exactly correct. And the scary part of it is, there's a game going on. They have these temporary tax rules, and they keep periodically extending the exemption for alternative minimum tax, okay? And right now, we don't know. Everybody's hoping that by year end, they're going to change it for 2012, but we don't know. So we're going the whole year trying to do planning, trying to work our finances, try to make business decisions, and we don't know whether alternative minimum tax is going to hit. But back to your point, which is when this was put in place, it was for rich people. Well, the fact is that slowly creeping inflation has reduced the effectiveness of the exemption because people make more and more money to buy the same goods and services while that exemption effect keeps going down. And so we're faced with a situation that the alternative minimum tax starts with adjusted gross income and then adds and subtracts kinds of things, is going to hit the middle class. And the government, it's having a harder and harder time upping that exemption because they're talking billions of dollars of additional taxes that they could take, and they may wake up one day and say, hey, we can't afford to give the higher exemption, and too bad, we're going to hit all these middle class people.
Yeah, that's my fear and huge financial phobia. And not only this, but how I got into this, why did I even approach AMT with life insurance? Back in the day when Ken and I were teaching at the society, I actually was asked by a CPA, Steve, isn't life insurance a preference item? What did I have to say? Well, it is.
Well, for corporations,
For
but
corporations.
not individuals.
And I wasn't really aware of that. I said, well, I didn't really realize that we were subject to corporate AMT if the death benefit goes back into the actual corporation. And there's certain rules and certain amounts of AGI that they have to have. There's certain rules. But I was taken back by that. So I had to go back to Ken and say, Ken, what gives with this? And he says, oh, no, that's for death benefit in a corporation,
Right.
not for income, personally held contracts like this.
Right.
So I want you to know, in some regards, when you look at your Social Security, it's looking for preference items on that line, and we're not going to be on that line.
Well, and that's the key, is because this is a Roth type concept, when we take distributions, it is not included in gross income for tax return purposes. Doesn't start up at somewhere in the top of the tax return and doesn't flow through. Whereas a regular IRA or an ERISA type of plan that isn't a Roth concept is going to create taxable income, gross income, and flow through, which will affect AGI, which affects ultimate minimum tax, taxation of Social Security, limits on deductions and contributions and all this stuff. So when you start factoring all that in, a Roth type concept, which a life policy is, starts to look really a whole lot more attractive in retirement mode particularly. And let's not forget that Medicare premiums are now predicated on adjusted gross income if you're in a high net income bracket situation. So I've become a real fan of a Roth concept, deferral concept, and life insurance fits nicely in there.
When we talk about things like this, you say, well, Steve, that's kind of a micromanaging the issue of AMT. But everything we're talking about, whether it's Social Security, provisional income test, the AMT, preference items, all these things just glamorize, in my view, life insurance as a retirement income play. And that's why I want to go down this road with everyone to give you the same advantage we have. We come back from the break, we're going to talk about the tax advantage income that life insurance and Social Security taxation can work together. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance as a retirement.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Have you been holding back on submitting your impaired risk case? Now's the time to dig them out of your files in the commission graveyard. Underwriters can be more like undertakers, asleep at the wheel of their hearse and driving your case into a ditch. But at Brokers Alliance, our triage field underwriting team drives your case to our special ICU unit. And because we're driving your case and not the underwriter, we can steer your impaired risk case to the carrier with the expertise specific to your client's impairment. We've separated the underwriters from the undertakers. We know how to breathe life back into your impaired risk case. Diseases don't have to be deal killers. They can be sales opportunities. And don't forget to download the copy of the Impaired Risk Field Guide, the most comprehensive impaired risk report in the industry. Go to www.impairedriskreport.com.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's giveaways at thebiz at brokersalliance.com, and we're giving away again the 1040 overlay. You should order this. This is huge. We're also giving away the marginal tax brackets for 2012 and solar, the self-owner life and retirement plan. What a kit that is. It's totally turnkey, so I want you to order that. Just write me, thebiz at brokersalliance.com. And just a heads up before moving forward with any of the ideas on this show, always consult your tax advisor and broker-dealer compliance officer. We're just talking about taxes. We're not giving advice. And in the segment, we're addressing the tax advantage income using life insurance, and especially as it plays against Social Security taxation. But before we get into that, Ken wrote an article, I have to say. He's a national financial columnist, and I'm reading this whole section on capital gain trap. And I read that thing and I flipped out. I kind of knew it, but not the way you framed it. Talk a little bit about that.
Well, what's interesting is I, like many people, gotten used to using software. Back in the day when we didn't have software to do tax returns, we actually had to do tax calculations, and we understood the process and the mechanics of the law. Well, when I started digging into the taxation of Social Security, well, the formula starts with adjusted gross income, adds in municipal bond interest, half of Social Security, and so you focus on those are add backs. But what's really subtle is capital gain. There is not a capital gain add back because you don't have to. when we ask somebody what is the tax rate for capital gains, long-term capital gains rates, is a maximum of currently 15%. Well, that's true. But the whole gain, if I make a $10,000 on a capital gain, that goes through Schedule D to the front page and flows down to the bottom line, which is adjusted gross income.
Okay.
Not at $1,500, but $10,000.
Okay, whoa. Okay. So I have a $10,000 capital gain. In my investor's head, I'm paying 15%. So I'm paying $1,500.
And that's partially true.
And I like that. That's great, right? So I pay it, I'm happy, it's lower than ordinary income tax rates. But the $10,000, the original profit, flows over to my Social Security provisional income tax. Is that what you're saying?
That's right.
And then what happens is it actually causes, it can depend on what other things you have, it can cause those to be part of the provisional income test, and now you're getting your Social Security taxed at an ordinary rate because of a capital gain.
Right. So
profit.
what happens is when that adjusted gross income hits the second page, they pull out the cap gain and apply 15%. But all of that income has pushed you into potentially a higher tax bracket for your other income, and alternative minimum tax starts at AGI. Okay, now they do back out again on AMT for the capital gain at the end, but you also have Social Security taxation, limits on deductibility of medical expenses. You know, AGI is one of these focal points that these formulas in different parts of the return focus back on that number, and capital gain is included in adjusted gross income for all those other tests. So yes, it is a tax rate of 15%, but that's that sneaky way that they do it now is, yeah, that is the tax rate, but it has impacts in other areas.
Right. That's the thing I want to bring up again. You know, we're looking at life insurance as a retirement income. Not only if it's done right through withdrawals to basis and policy loans to gain and keeping the contract in force for the life of the insured and a lot of other things that I'd love to caveat if I had time. Remember, when I look at this, I'm not going to experience not only ordinary income tax, but I'm not going to be playing in even capital gains, which is the big trumpeting issue of holding stocks long term. I mean, this is the big game. And I keep saying, if you're doing it for other spending issues, I get it. But if we're talking about a retirement plan, everybody has Social Security. Well, maybe not the Amish or whoever opted out back in the day. But most of us have Social Security. So that's our retirement plan. And the last thing I want to do is bring more income to see that get taxed, especially at that top exposure of 85%, not 85% tax bracket, just the exposure of that income.
Including 85% of it as income to be taxed.
So to me, that's an issue. And by the way, I just brought this up. I might as well cover it right now. You want to also have a contract, Ken, that's being kept in force for the life of the insured, because if you're taking all these policy loans out tax-free and you decide to do the dumb thing, which is outlive the maturity date, you're going to have not only ordinary income tax on all the policy loans you took out on that contract, but hey, heads up, nobody pays the interest hardly at all. So any interest that's been accumulating and cannibalizing cash values on the inside of this contract is also going to be a taxable event. So be careful. You better have a contract. That's why we look at this all the time. What's the endowment date? What's the maturity date? What's the contract say? Not the current company practice, but what does the actual policy provision, what does it state? And I noticed that once we started getting into this, everybody jumped to maturity date 121. I mean, we just flew out there to these numbers. Think about this. One of our carriers right now, one of our top index carriers, Ken, not only do I always price their product to age 100, but that same premium, that whatever that distribution is at whatever we're illustrating, remember it's just illustration. It always goes out to 120. It's one of the few carriers that actually illustrates whatever goes to 100 goes to 120. Wow. We need to start thinking this way because that's where the income market's going. We're talking about these little taxes that can get into it, and I want you to finish off with one real quick run on Social Security taxation, just do a redux on the 85, 55, you know, that can kind of just tie us up before we head out.
Yeah, basically what the government does is it says, okay, to determine whether or not any of your Social Security income is taxable, whether you're single or married, they have different formulas and numbers, but basically you take adjusted gross income at the bottom of the page, add half Social Security, your municipal bond interest, come up with a number. If it exceeds certain thresholds, first it's 50% included, then it's 85% included.
I think when you look at the provisional income test, which we have and we'll send it to you absolutely free, when you look at these numbers, you can understand why this is a punitive tax for our seniors. Remember, you can watch this show and, of course, all our shows by clicking on the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.